long-term care, there's a lot of risk for seniors because, every person I know now, I play a lot of golf with a lot of seniors.
You do a great job playing golf,
Yeah,
by the way.
everybody's got a condition or a situation.
Yeah. Well, it happens. And so one thing we can't plan for is the unexpected. But we have to have money put aside for those unplanned events, called emergency account or whatever, or liquid money. And so if you lock all your money away, if you're putting it all in these stocks that you're hoping are going to one day go way up and they're not, you feel like you're captive to your investments. Like I've talked to a lot of millionaires, but they have all their money tied up. They don't feel like they're millionaires at all. So it's about having financial freedom. And if you set your portfolio up the right way, Tom, like you've done, you can feel financial freedom. I can tell by looking at you, you feel financial free.
Yeah, I mean, I'm not just talking the talk, I'm walking the walk.
Right.
And I'm out there every day and play golf 4 to 5 days a week.
I see you.
Pickleball 2 days a week. I mean, I'm taking it serious. My wife and I are going on Viking cruise from Budapest to Amsterdam. That's what retirement's supposed to be about.
Having fun.
Is having fun. And that's what I'm doing.
Welcome back into our series on the big book on retirement. I'm Thomas Lipscomb, again here with you alongside the best-selling author himself, Coach Pete D'Arruda. Chapter 4, if you have your book in front of you, you already know what I'm going to say, but it is prioritize training and conditioning. This is a good one, Coach.
Yeah.
So prioritize training and conditioning. When I think about this, I think working out and getting myself in better shape than I am right now.
Get your body in shape, but get your mind in shape and make sure your plan's in shape.
Okay, yeah.
All right, so
I'm tracking
same
that.
kind of concept. I mean, you can tell if you ever watch a sporting event, some teams look more prepared than others.
It's true. So that's a good thing. Now,
Yep.
preparing for a sport, you may run, you may do some cardio, then you may want to work on your
Lift weights, these kind of things.
What about retirement? You've got top 10 ways to prepare for retirement here. So
Yeah.
this is basically that training regimen for retirement.
Yeah, one is to familiarize yourself with your Social Security benefit. If you do that, the government can go back 5 years and saw you move money on purpose. You can get in trouble for that.
Yeah.
And do you really want the government to decide where they're going to put you? If you're on Medicaid, you have no control about what facilities you go to. And they're not going to be, many times they're not going to be the best.
Right.
But if it's better for folks that don't have any other option, it's good, but it shouldn't be abused. Let's say you retitle all your assets in your son's name and he decides to get married. So now afraid to ask questions to begin with. Don't be afraid to ask questions, and don't be afraid to ask for the answers in writing, by
That's
the way.
good.
We
Yeah.
give all our answers in writing, by
That's
the way.
good.
We
Yeah.
give all our answers in writing because someone can say anything, and then they can deny they said anything if you don't have it in writing.
Yes.
So
yes.
make sure you get it in writing. It shouldn't be confrontational anyway. We are here to help you. We want to make sure that you have the best retirement possible, and any planner should do that too. So every decision we make is in your favor. That's the definition in my mind of a fiduciary.
Yes.
Is in your favor. That's the definition in my mind of a fiduciary.
Yes.
Always doing what's best for you. If we benefit, so we explain when we benefit. Information's on your bookmark, or you can see the number on the screen.
It's amazing that you do it at no cost because there's so much value behind this. But folks, make sure you are asking the right questions. I think as you've head through the first few chapters of this book, you'll see that it's all about preparing, conditioning, getting that plan in place. And we're going to get into even more detail later on. But make sure you're asking the right questions. Contact Coach Pete and the team today. You see the numbers and information on your screen. Get that total retirement income plan.
We say be prepared, not surprised. Just be careful of where you put your money. Make sure not to put all your money in one place.
Yeah.
Pick out 20 that you really like. Make sure they're not meme coins unless you're going to actively watch that and get in low and get out quick in a matter of hours or seconds.
That's good, yeah.
I like long-term holding. I like Bitcoin. I like Ethereum. I like, I like Solana, and I like Ripple, and I also like Nano, and I like T7X, and there's a couple other ones out there. There's some good ones out there. So, but you need to find what you like. This isn't investment advice. You pick what you want, but I'm just saying pick strong ones. Pick ones that aren't overly feeing you. That's one thing I don't like about Bitcoin and Ethereum is the gas fee, the transactional fee. I think eventually, they've done a good job of getting us to this location here we are in the crypto world. I think Bitcoin and Ethereum will always be here, but I think there'll be other coins that come up that people start trusting and believing in that are a lot cheaper to use to transact with. Hey, I'm Coach Pete D'Arruda, president of Capital Financial. Folks, the financial world is very, very confusing. That's why we put together a series of educational videos called webinars. You can see them at any time by signing up at CoachPete.com. We'll see you there.
thanks for spending a little bit of time with us here on our info series, Women and Money. I've got Miss Jana, Miss Amanda,
Hi.
I'm Jackie, and Coach Pete. He is giving us all the great information. We're asking him questions. How do we proceed through the stages of our lives as women with our own money? And one of those is securing lifetime income. Is this only a discussion for pre-retirees?
I think it's any time. I mean,
Okay.
we need to always talk
Good.
about it until we accomplish it. And once we accomplish it, we always need to be thinking how we can get more than one stream of income. You know, when we retire, we got Social Security, supposedly. I get that
Hopefully.
income.
Yeah.
But we also need to have some money that we put aside on our own in our 401ks,
Yes.
our thrift savings plans, our 403b, wherever we save that money. But the problem there is we save, and we build up this nice lump sum. We see the lump sum, it looks nice. So you won that race, you built up that money. The problem is there's another race getting ready to start, and that's the race to retirement income. How do we get the most income we could qualify for without ever running out of money? And so that's when we do income planning. We've heard that before. Based on your lump sum right here, how much can we translate that lump sum into to give you a lifetime income you can't outlive for you and your spouse? And we do that every day. And so the answer to your question, it was a long answer, is anytime you're ready, we can discuss income.
Okay.
But once you get it discussed and accomplished, you never have to worry about it again.
That is a beautiful
So that's
thing.
a good
Yes.
thing. Get it, that little green check mark.
I wish they
They
would
put in
teach
front of
this.
it.
Aren't they going to start teaching this in school?
Well,
They've
they're
said
not,
that
and
for
they're never
2
going
years.
to teach you the
Right.
right way. You need to deal with someone who really specializes in lifetime income, not
Okay.
just how to save and where to save
All right.
and what to do there. It's how to get that lifetime income you deserve. And most folks don't specialize in this. They specialize in trying to grow your money, grow, but never tell you how to preserve, protect, and give you lifetime income. That's what Coach Pete does.
The hidden fees is the one thing that
Oh,
the
financial
termites.
Financial
termites.
termites.
Oh my
are
gosh.
all in some of these plans. So and you can't see them.
No.
Sort of like a real. That's why we call them financial termites.
Yeah.
Termites at home are invisible, but they're doing damage. Fees in your portfolio are invisible, but they're doing a ton of damage. They could take half your income away if you don't know what you're doing. So let us analyze your portfolio first, a forensic financial fee analysis we call it, and identify all the unnecessary risk, fees, commissions you're taking, and then put a plan together that makes more sense for what you're trying to do. Have income all the way through retirement. We do it every day.
Yeah, because we're just kind of, I feel like we're going through life and putting money in this 401k account. You know, you're a busy woman.
And you go
both are
without
busy.
because you're putting money in this plan.
Yes.
This plan better be working, and it better
Yeah.
be more money than I put in the future, or why didn't I just have fun with this money?
And you haven't
Right.
diversified. You've messed up.
Yep.
You've put all your eggs in one basket,
That's
and then
right.
all of a sudden, here you are, high and dry at retirement age.
The
Right.
income basket needs to have a whole lot of eggs in it when we get close to retirement, because they're
Yeah.
going to hatch all the way through retirement. You're never going to have any worries again.
Yeah, we like that. We know
Yeah.
how to make eggs hatch.
Yeah.
We do the income plans better than anybody out there. I
Yes,
guarantee you.
yes,
I'm 33 years doing this,
Yes,
so
I
that's a
know.
long time, by the way. I know I have boyish good looks, but
I just
am
wanna-
59.
I want to make the point that it's so important because if women think they're going to live on just Social Security and take
scary.
Right, take a little money out of that IRA that used to be our 401k. You might run out of money, and women 65 and over are more likely to face poverty.
Well, if they don't do the right plan.
That's right.
My clients
That's
never have
scary.
poverty
I
because
know.
we put an income plan together that guarantees they'll never be in poverty.
Great.
Unless you spend all the time
Yeah.
and then spend more than you have, or go to Vegas and get into debt with credit
Well-
cards. There's nothing anyone can do about that. But we'll show you how to properly use credit cards, how to properly have fun, and to have income you never have to worry about outliving. It's not as hard as you think. And
Good.
there's nothing to be intimidated by the money world. I know the big words are used a lot of times to try to intimidate you. Like
Yes.
when you go to a doctor, they try to use these big words.
Don't I know
The
it?
pharmaceutical industry, these drugs are like this long, like the
So true.
words are, and then the disclaimer at the end, where all the bad things that can happen,
side effects.
it's probably worse than the regular thing. I just got my shingle shot today, first one, by the way.
Ah.
So we'll do an update on this next time we
Yeah,
do one of
please.
these. But you're supposed to do one shingle shot now, and then I have to get another one done like three months
booster,
from now.
yes.
But the good thing is the side effect of following your plan is you're going to have long-term growth and
There you
retirement
go.
money.
The side effects to
Yeah.
Coach Pete's plan is lifetime income and having to
Yay.
spend money. Sometimes here's what happens, guys. You
Yeah,
won't believe
Hopefully
this.
no shingles.
Yeah.
But I'll meet with folks after a year or two in retirement, and I'll look and I'll say, "You're not spending all the income we have put aside for you," because they're worried they're
Good.
going to outlive it. I said, "No, look, this money's going to come every year. It's never going to stop coming. So spend it,
Right.
Because your kids will if you don't.
Yeah.
So spend it now. Have
Isn't
fun
that
with it."
true?
Yes.
Well, how do you create, you talk about the simplest way. So for me, I just worry. I'm a anxiety-driven kind of person.
Yeah.
I worry so much. So what is the simplest way to just start, to just create this plan?
The simplest way to start worrying, to stop worrying,
Yeah.
sorry, to stop worrying, is to do a plan.
Okay.
Because we all worry. We worry, and we we worry because we're afraid of what's going to happen, but we never do something about it. So we stay worried and we give ourselves an ulcer when all it takes is a 1 hour meeting with me for me to figure out where you are now and what you want to do, and then another 1 hour meeting for me to present my team and I have come up with to put you in control. Now I do a lot more work behind the scenes, but for you it's only 2 hours and we can get you all set. So that's 2 hours of never worry again.
Okay.
That's the baby steps you talk about.
Baby steps, and we show you, and we actually outline it for you. We tell you the who, the why, the where, the wow, the why, and the what.
All of it.
All that and the how. And we do it all for you, though. So we show you what we did, but we also tell you how we did it just in case you want to do it yourself. So there's nothing worse than somebody just throwing something in front of you and you not knowing, like when you go to get, let's say, a dozen donuts and they charge you $29, and you say, wait a minute, it's a dozen donuts. Let me see the receipt.
Yeah.
So we show you the receipts to show you how we got to where we got.
Yeah.
Okay?
I think
So it's important to see the receipts.
Today we've talked about so many different stages. You know, we went from graduating college to getting married to getting divorced, and here we are, you know, approaching retirement or being in retirement. But a lot of people just think, I'll do it tomorrow.
Yeah.
I'll
Isn't that
wait.
true?
It's not
So true.
right now. There's so much right now that's on my mind. I'm just going to put it off. And a week becomes a year. And then 10 years down the road, I'm like, oh my God, I could have done so much.
Yeah.
Had I just stopped and called you and had you do it for me.
It's so easy to procrastinate. We all do it.
We
So,
do.
Yes.
Again, it's about making that step. This is a lifetime decision. A lot of people are afraid it's your money. I understand it's your money, but leaving it where it is not a solution a lot of times. If it's at risk right now, we've been pretty spoiled the last 15 years or so. We haven't had a market crash, one of these big ones that stays down.
Yeah.
What if you left all your money at risk and it was going up, and then all of a sudden we have the roller coaster and it goes down, 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 and then you get ready to retire and it keeps going down? You're in trouble because number one, you don't have a guaranteed lifetime income plan yet. And then when you have to start taking money out, you're taking it out and it's way down, you're locking in your losses, and you're having to take out more stock than you ever imagined because the stocks are way down in value. So we have a solution for this. Again, we'll do a forensic fee analysis. We'll do that total retirement plan, we call it, and we'll give you a GPI plan: growth, protection, lifetime income. There's not much more anyone can ask for in this, and this puts you, man or woman, in charge of retirement.
I love the sound of that.
And you get confidence when you do that, so you don't worry anymore. I've taken people that were worried, and they were still working, and told them they could retire tomorrow. Matter of fact, they could have retired 2 or 3 years ago if they met me, and put a plan together now that gives them double the income they were going to get if they kept working. We can do that. It's about lifetime income planning, utilizing what's available out there, telling the market to take a hike, by the way. We don't need the stock market once it's done the good job. That's the second phase of the relay race, is safe money and lifetime income, and you never run out of money. Perpetually goes around and around, sort of like playing Monopoly and never worrying about going to jail. You're always pass and go.
Hey.
And we can do that for you.
I love
You
that.
make it sound easy.
It is a lot easier than Wall Street tries to make it look. The hardest thing, though, is getting you to pick up your phone and calling us to schedule an appointment. We're trying to help you. I know I don't like going to the doctor or dentist either. They're trying to help me as well. We are really trying to help you, and this is a way for you to perhaps get 50% more lifetime income than you ever imagined. 50% more than you were going to get.
Get started today.
Get started today. We'll show you how your numbers work with your numbers and your life.
Call Coach Pete.
%54% of Americans say that inflation is the #1 risk that they're facing. And I mean, prices have gone up. I went to Vegas a while back and I just kept saying, that's crazy. That's crazy. That's ridiculous. That's ridiculous.
Yeah.
How do people handle inflation?
It is, I have a radio show, been about 22 years on national radio, and we've talked about inflation for years, but no one would pay attention. Now, the last 5 years, people are now starting to pay attention. Right. Things are getting, and they were getting more expensive as we went on because there's no 49-cent gas anymore we had in the 70s, but it was so slow. It's sort of like when you put a frog in a pot of water, and you turn up the heat very slowly, he'll boil to death eventually. Whereas if you have the boiling pot already boiling, you drop a frog in, he'll jump out. So now we're starting to notice it because we're seeing that boiling water. That's the inflation. So what are you going to do about it? Make sure that your assets are outperforming inflation.
Right.
We can't have our money sitting in a CD. That's losing money safely, we call it, because CDs are paying, let's say, 3%, but inflation's 5% back in the day when inflation was 6, 7, 8. But inflation's still pretty high. So we have to have our money growing faster than inflation rate. But we also don't want to take too much risk with that money.
Right.
Because you're not going to keep up with inflation at all if you're losing money.
Yeah, and the knock on income annuities is they don't protect against inflation. Well, there's several ways to do it. Number one, you can buy inflation protection, a cost of living that your check goes up every year. There are some companies out there that if the market goes up, your check will go up, but it won't go down. It'll only go up. That's one way. And so the other way is, you do what I do, and that I got 13 of them, and I've laddered them so that they kick in at different times, but that increases my income over my life.
The negative things I've heard about annuities over the year, Tom, and especially from some of the writers who don't understand the financial world, they write just about, they pick one annuity out of a bucket of thousands, and let's say they grab a variable annuity. Right. Now, I've never offered a variable annuity. I don't really believe in them. There's some good ones that seem to be coming out now, but back in the day there haven't been, but they have a lot of fees and mortality expenses, and you can lose money. So you put money in, it can go down. So the true annuities that we've always offered, you have that ratcheting up effect. The worst case scenario is you get a 0 for the year. But if you get a 0, that means everybody else is probably negative 10, 20, 30, who knows where they are.
Right.
So the next year you're starting from here, they're starting from down there. So when it goes up, you're going up. So you're not going to get rich quick in an annuity, but you're never going to get poor.
Folks, we have a very interesting guest this week. Matter of fact, if you've ever heard of something called the 4% rule in the money world, we're going to have the inventor of the 4% rule, Mr. Bill Bengen, on. And Bill is joining us from Tucson, Arizona today. Bill, welcome in.
Oh, thanks for inviting me. Looking forward to it.
Yeah. Now, like I said, you're the inventor of the 4% rule. How did you come about that, and what inspired the research behind this 4% rule that we hear about?
Sure. I was a relatively new financial planner back in the early 90s. Not a young one. It was a second career, but I got into that, and I started fielding questions from my clients who were, basically baby boomers with about 20 to 25 years to retire. And they were just starting to think seriously about how much they should be saving and what they could spend in retirement. And I tried to find guidance on, the spending withdrawals, and couldn't find anything anywhere. No books, no magazines. All our other financial advisors were all over the map with their answers. So I decided to sit down with a computer and find solutions myself.
Well, you said this is your second career, and I want to tell folks a little bit about you. You were born in Brooklyn, New York in 1947, and then you went to MIT as a rocket scientist. You had a BS in aeronautics and astronautics from MIT. That is fascinating. Then you worked for your family's soft drink bottling company after that. So you have a research mentality, don't you?
Yeah, I've learned something for every career I was in.
Tell me a little bit about the bottling career. That's a fascinating concept to me.
Yeah, well, that business had been in our family since the 1880s. It started out as a small backyard soft drink business in Brooklyn. In those days, soft drinks were not consumed year-round. Generally, they'd shut down after Labor Day and open up, sometime in the spring, which is pretty amazing when you consider what the business is like today.
Yeah.
But the business grew. They picked up the 7-Up franchise in the 1930s. The business grew and became substantial. And I was very disillusioned with what was happening with the space program, so I decided to accept the invitation to join. And glad I did. I learned a lot there.
Yeah. Well, so you got your degree, you did the bottling, and then something must have gone off in your head about 17 years into that career as a bottler, working in a bottling plant and working behind the scenes. And you decided to be a financial planner. Tell me about that.
Yeah, sure. Well, first thing, we sold the business in the 100th year that was in the family. So I no longer had employment. So I had to find it. And I spoke to my wife and kids, and let's not get stuck here in the cold Northeast. Let's go somewhere where it's nice and warm in the winter. So we ended up in San Diego for many years, and then finally here in Tucson.
And so you were in the financial planning career. There's a lot of us out here, and you must have been sitting down one night and you said, well, I need to figure out how much someone could take out of their portfolio and not run out of money. Is that how what was the thought process to come up with the 4% rule?
Much.
And what year was it?
Sure. That was I did research in 93 and published a paper in 94. And essentially what I was trying to answer was, what was the worst case situation in history? If you wanted to be ultra conservative and withdraw at a rate which guaranteed 30 years based on anything that's happened in the last 100 years, what would it be? Turned out to be about 4.15%. was the worst case, which applied to the person retired in October of '68 who ran into a buzzsaw market, bear markets, one after the other, and then terrible inflation, which was to increase their withdrawals.
We call that sequence of return risk when you retire into a bad environment like that. And
That's
so
right.
you tested those back in the 90s, and what surprised you most when you were doing this research on the 4% rule?
Well, I was surprised at first when I looked at the asset allocation. I wasn't sure how much you need in stocks and bonds. And when I ran the numbers, it clearly indicated you need a very substantial position stocks, 65% probably, and bonds not so much. If you go much higher than that stocks, you get hit with a bad bear market, you get devastated. If you go low and with more bonds, you won't have enough oomph in the portfolio to generate the returns you need to get the withdrawals.
Right. And when we say stocks these days, there's so many stocks, and people need to diversify properly, or they could pick the wrong stock and be bankrupt in 2 days if it's a bad stock. You see some of these stocks go like a rug pull, and they don't exist anymore. So how can someone make sure they're picking the right stocks to go along with the 4% rule?
Well, I think diversification is the key. Invest in funds broadly diversified across markets, across countries, across industries. Good high-quality funds. There are plenty of those. Most of them are index funds at very low cost, so that they are easy to swallow. You're not dealing with friction, commissions, and so forth.
Yes.
So it can be done. People today are very fortunate to have this available to them.
Now, when we hear about different rules of withdrawals that you can make sure to have a successful retirement, Susie Orman's saying 3%. I've even heard someone say, Dave Ramsey says 8%.
Uh-huh.
What are your opinion on those or that range? What do you think about that?
Well, I haven't sat down with either of them to discuss the basis of their feelings, but just looking at my own data, I use historical data. I basically reconstruct the portfolios of investors retiring in 1926 to date. I had seen nothing in history that indicates anything less than 4.7%, which is the new number, my updated number. And to get below that, we would have to have something like in the 60s and 70s again. If you remember, we just had terrible bear markets followed by years of high inflation. And I don't see that on the horizon yet, at least.
What's your opinion on the S&P 500? Is that a good, I know Vanguard has a really good one. VOO is the symbol. That's a pretty nice S&P 500 fund. What do you think about that one as far as being included in that portfolio to get this 4.7 you're talking about?
It probably makes sense to do that over the long term, although on the short term, you're going to have to be careful because stocks are very highly valued and very concentrated in a few names, so that not always doesn't end well.
Now, you said you've been quoted that the 4% rule was never meant to be a law, more of a process. How should people use it today without locking themselves into a rigid number, I guess we say?
Yeah, I've identified in my book what I call 8 elements, which are basically assumptions that you can use to personalize your withdrawal plan. They include things like the planning horizon, how long you're planning to withdraw money, what type of account, taxable, non-taxable, do you plan to leave a balance at the end of the account for your heirs, and so on. There are those 8 factors. You get values for each of those, and then you can next step is take a look at stock market valuation and inflation. And using those 2 factors, I've got tables set up so people can just look up their number.
Nice. Now, folks, we're talking to Bill Bengen, and he is the founder of the 4% rule. And Bill, for retirees worried about inflation today, what's the best way to protect their spending power long term?
Well, that's a real concern. I always say that inflation is the greatest enemy of retirees. I think in the bond portfolio, they could use tips, significant exposure to tips. And I think also they want to invest in top quality companies that go through a rough period of time of inflation and come out okay. They've got pricing power.
This is more of a psychological question than a financial question, but do you think retirees today are more likely to run out of money or leave too much unspent out of fear?
The biggest problem I'm aware of is not spending enough. A lot of folks think that they can just spend off their interest and the dividends and live off that. That really constrains you tremendously. You have a much richer lifestyle. I imagine the heirs must be very pleased with that because that means they're going to get a lot of money. but that don't help the retiree much.
Bill, I had a client about 20 years ago, and I said, I said, John, you're not spending much money. You've got all this money. He had millions of dollars. I said, you need to start spending it, having some fun because you're retired. And he said, that's a good point, Coach, because my friend, he had a friend who said if he doesn't spend it, his kids will go first class and spend all his money. So he still had got that. He was still afraid to spend it, but his friend was putting pressure on him to start spending it because he said if you don't spend it, your kids will.
Yeah, there you go.
That's about what you were saying right there. What's the biggest misconception about your rule, and what do you like to clear up now, once and for all, that we're on the air? What do you think that people just don't understand about the 4% rule?
I think a lot of people think 4% or 4.7%, as I now phrase it, means that you take out 4.7% of your portfolio value every year, and that's not the system that the rule is based on. It's based on more like a Social Security system, where the first year you use your percentage. It's 4.7%. You have $1 million in an IRA. You take out $47,000. After the first year, you throw away that 4.7% and just simply give yourself a cost and living adjustment like Social Security.
So you increase it a little bit every year, over and above that what it was. Okay, and even in a down market.
Yes, my methods are designed to get you through bear markets. I mean, one thing about bear markets, we know they're nasty and they can reduce your withdrawal rate, but they don't last forever. They'll get us a recovery and you'll come back. So it shouldn't be too impatient when that happens.
Now, tell us about A Richer Retirement, a book you wrote, and what can readers expect, and how can they learn more about your latest research as well?
Sure. Well, my book is basically designed like a cookbook where people can go to it and find recipes for a way to construct a withdrawal plan during retirement using 10 basic fundamentals. And then my website, bengenfs.com, I have developing a whole library of scenarios that people can look up something that's close to their own situation in terms of the 8 elements, then possibly use that as a template for their own retirement plan.
You know, a lot of times I'll sit down with a couple, and one of the two in this couple will be very risk adverse, and the other one will be a very big risk taker. How do you deal with a couple like that?
Unfortunately, I don't have to deal with it anymore. I've been retired.
Back in the day, how'd you do that? How'd you deal with people?
It was tough to reconcile. Yeah. You had to try and sit with them and sort out some of these financial issues. Some people are just very fearful of certain things. It's irrational, and there's not much can be done. Just reach a compromise if you can.
Now, finally, I want to wrap it up on a subject that a lot of people have heard about, because critics have said that 4% rule is obsolete after the 2021 to 2023 inflation shock. Is that fair, or is that fear-mongering that they're saying that?
No, it seems to have survived it okay. Now, of course, that's only a few years ago. We don't know what will happen over the next 10 to 15 years, which will have a lot to say about what happens to people retired back then. But right now, they're starting out okay. They got hit with a bear market, but then they got a huge recovery, after that. So they're back in clover, I think.
We've been very, very lucky, haven't we, with these V-shaped recoveries we've had in the last 20 years?
Yeah, that's right.
Look at Japan. I mean, it took them forever to recover or get back on the right track, and that's the only thing that worries me, Bill. And I think that these days, though, I think the average investor is a lot more astute than they have been in the past. I think that's why they may help the recovery more than the stock companies themselves help the recovery, because people they have the fear of missing out. So when the stock goes down, they jump in and buy many times. And
that's using the correct strategy. Whether it is today, I'm not so sure. Yeah. But yeah, I agree with that.
Back in the day, they say, trying to buy a falling stock was like trying to catch a falling knife. Yeah. And that is true on some of these penny stocks that go down. But for the traditional S&P 500 companies, that doesn't really apply these days, does it? I mean, it is good to buy low and sell high.
Yeah, I think if you're investing in a broadly diversified fund, you're protected against individual business risk. And you should just be fine over the long term.
Well, folks, his name is Bill Bengen, and his book is Richer Retirement, and he is the inventor of the 4% rule. Bill, thanks for your time today.
Thanks for having me, Pete. Appreciate it.
And, folks, we'll be right back after this.
What are your thoughts around long-term care?
I really like the concept. I've never liked the policies.
Yeah.
The policies haven't been good. I've been licensed to offer long-term care for over 30 years, and I've never offered a single standalone long-term care policy. Now, I have offered a lot of these new life insurance policies because they have the long-term care. They've got, well, let's say you don't need the long-term care. It turns into a tax-free death benefit.
Right.
Let's say you need income in retirement. If we set up right, you can get a tax-free retirement income from it. Life insurance is really the Swiss Army knife in the financial world.
Yeah, I think more people will be going towards the life insurance way because I own the traditional long-term care and it's a great product. So I'm going to get benefits. I got a good one before, but the premiums have gone up.
Right.
Now we've been told they're not going to go up anymore.
That's what they always say.
I hope that's true. But the nice thing about the life insurance is that you've got this bucket of money. And if you need it, it's there. If you don't need it, you can take it back out as an emergency fund, or if you don't need it and you die, it goes tax-free to your kids. So it's a 3-in-1 type solution. I think that's going to fit a lot more people. But even people who are already can't buy that policy, they can't buy because they have medical problems, they have health, they can still get an annuity with a long-term care rider.
Yeah, that too. I mean, so you can always, there's always a way. Yeah, you can't take the first rejection and say, well, life stinks, I guess I'm going to have to be where I'm at. No, there's always alternatives, Tom. And so that's what we've specialized in the last 30 years, is finding the alternatives to get you where you need to be.
And that's why I think it's so important to work with a financial professional.
Hey guys, it's Parker Holland here, Chief Wealth Strategist at Capital Financial Advisory Group. We do a lot of case studies on the radio. You've seen us talk about it on our video series and TV shows, but we like doing real world examples. So we have a lot of people ask us, can you run the numbers for us? And they're even comfortable with us using them here on the board for you. This is a real study from a radio listener that came in, and we're not looking at the comprehensive plan here where we go tax, healthcare, Medicare, Social Security. We're looking solely at the income off their investments because that's what we all save for. Bills and taxes never stop, but paychecks do. Like Coach Pete says, you got to replicate the income. So here's a real world example for a radio listener. They're currently 57 and 55. Husband and wife, spouse, doesn't matter what you're looking at. There's normally always an age difference most of the time, but they're looking at retiring in 7 years. So what we're looking at here, this will be age 62, and then of course with layover, overlap, this is going to be closer to 64. Now, they had about 1.4 million in retirement savings. Now, Wall Street is going to recommend that you take the younger spouse's age, subtract it from 100, and that's the risk versus safety. Unless they're more conservative, it can flip. Now, in this scenario, we don't run off a risk tolerance. Our plans and strategies are focused on income and standard of living. We want to make sure we're able to maintain the income they need. When we ran the numbers based on what they have and we backsourced it, that put us at around $560,000 for their plan, and that's what I'm going to use here in this example. $560,000 with an A+ rated company. That's going to be a worst case scenario for our clients. So that means that no matter what the market does, they put in 560, we know it stays 560. What we're doing is, instead of holding an IRA or a retirement account with a custodian broker like Fidelity or Vanguard, we use insurers like Nationwide, North American, Athene, Allianz, A+ rated, and they all incorporate strategies and incentives, whether it's bonus percentages, dollar values. Well, here we're just talking about income. We're not focused on what the accounts are doing for bonus or incentive. We're focusing on what they generate. So worst case scenario, we want to know, no matter what the market does, what does that 560 get us? Targeting a 7-year window. Now, age of death, we normally do spreadsheets and 30-year models, but in this scenario, let's go a little farther because people are living longer. Let's go to age 97. That income received, worst case scenario, is going to be $60,000 a year. Now, that's off of the $560,000 number. This is assuming 0% returns, which means by age 97, there'll be no money left, but they're still getting the income. The spouse is, no matter who outlives who, or if they die at the same time, that standard of living is going to be met. We're not counting outside accounts. We're not counting Social Security. We're solely looking at that 560 alone. Now, we know we got bigger issues if the market does 0% every single day. So let's look at actual performance. 7 to 15% over the same life expectancy. We're not looking at a set rate of return here. This is where most calculators get in trouble. They run a fixed 7, 9, 10% number. The market doesn't do that every single year. The market fluctuates. It has years of negative 20, positive 20, 7, 15, 55. Let's just say it stayed between the historic averages over the next 40 years. That means that the income, instead of starting at 60,000, would start closer to 70,000. 57, 55, wait 7 years, what's it do? Well, that income is going to continue to grow every single year as well to 160,000 plus. That's inflation protection. But the goal is to live off the icing without touching the cake. What does this number grow to? Well, as I just mentioned, we're taking income, but our goal is to not drain principal. That's going to be over 3.7 million left for their heirs in that same period of time. These strategies are targeting growth, income, consistency without picking growth or safety. We're eliminating the focus in the standard norm and focusing on income yield so that the outside accounts, Social Security, everything else is icing on the cake. If you want your own plan or strategy or you want to see what your numbers do, give us a call, shoot us a text, go to our website and just poke us and let us know what you're looking for, and we'll give you your own exact numbers.
Invest in these meme coins unless you have a strategy to get in and get out real quick. Don't sit around when it goes up a little bit with your calculator saying, well, if it goes up to this amount, I'm going to be a multi-trillionaire.
Yes.
Of course, it's never going to get there and you're going to lose all your money. So if you've doubled your initial investment, sell half of what you put in, and now you're playing with the bookies money, we call it, because you've got all the money you invested back.
There you go.
Well, a whole lot easier to hold something long-term, Bruce, when it's not really costing you.
One of the big risks in retirement is sequence of returns risk.
Oh, yeah.
Americans do not understand that risk. So kind of, how do you explain it?
Well, basically, the day you retire is a very big day, and it can become a gigantic day if the market starts to go down that day. So now you're starting to take money out of your retirement. This is if you don't have a real plan put in place. A lot of you're trying to manage yourself. You're just going to take money out of the stock market accounts you have, and you're going to supposedly you have that 92% chance of being okay. But the market keeps going down. You keep taking money out as it goes down. The beauty of the stock market, if you have the time horizon on your side, is if a stock goes down and you really believe in it, you don't have to liquidate it. You hold it till it comes back up. If all that money in the stock market is money you need for retirement, you're going to have to start liquidating that money because you need it. So that's why we say keep that stock market money alone, build a force field around it with annuities. So have annuities give you the income of retirement and leave your stocks alone. Therefore, the stock market can do its thing. Stock market doesn't go up all the time. It doesn't go down all the time. But over time, it goes up if you have that time to leave it alone. Usually people buy high and sell low. That's what happens. But if you're selling low because you have to, because you need that income, you're not in the right place. You don't have a true retirement plan.
Yeah, and what's even worse is the more the market goes down, the more you have to sell.
Yes.
Because your shares are worth less and less, so you got to sell more and more to get that in.
So you're locking in your losses.
And so people who retire into a down market, and if they don't have a plan like you're talking about, they're just taking money out of the market, they have a very high risk of totally running out of money.
Yeah. And
versus somebody who retires into a bull market, they can take money out. They have a very high chance of success. It's just we don't know what's going to happen on the day we retire. So I call it good luck or bad luck. And I don't want to subject my retirement to good luck or bad luck. And that's why I have a plan like what you talk about.
that's the Vegas mentality. We don't have time in our retirement accounts to have the Vegas mentality.
Hey, it's Amanda here, back again with my friend, Coach Pete, and I am so excited to see you. We have really dived in 2025, looked at the good, the bad, and the ugly about my finances, and I mean, it was tough, I'm not going to lie, but now that we've gotten it going, I'm ready to start investing some money.
We started, you said, Coach, I want to get my finances back under control or under control for once or whatever you said.
Coach, I'm in debt. I'm in debt. We bought a house, we bought furniture, we bought all the stuff to go in the house, we bought new curtains and glasses and dishware. how am I going to start investing if I'm in debt?
So we put a plan together. And what
did.
did we do in January?
So in January, we started buying the debt down.
Yep.
And really started
Buying the
working
debt
on
down.
like the smallest ones and really paying those off. And I have thrown like every extra penny that I could possibly throw at it.
You took the highest interest rates. That's what we identified. Those are the big termites, the financial termites, high interest rates. Doesn't matter what the balance is.
Yeah. Well, and I had some furniture and stuff that was 0%. So I said, I'm going to wait,
Yep.
I'm going to get that last because it's 0%.
Don't wait to the last minute on that, though, because if you don't pay it on time, they're going to go back and charge you interest on from day one. And zonk you and put fees on there. So you need to pay that.
Wow.
And don't wait till like the day before. Make sure you pay that off like 30 days before they say that if you don't pay it, they're going to get you. Okay?
Oh, financial termites.
Yes.
That's why you got to get a copy of his book. And I think for me, the next question is, what do I need to be focused on with, investing? Do I need to get into crypto? I'm trying to maximize Jackson's college savings account and then my Roth IRA. And it's a lot. Like it, honestly, it's hard for me to manage the day to day.
Instead of jumping right into crypto, like getting your own Coinbase account, some of the brokerages like Fidelity and stuff have their own Bitcoin account. So they're investing in Bitcoin for you, so you don't have to go through all that. You just invest in their ETF, it's called, like a mutual fund. And IBIT is one of the ones you get in that you can own crypto without having to go through all that crypto game. IBIT is a symbol. It's doing pretty well since it's come out. So look at that. You shouldn't despair. You've done a good job of paying some of that debt off, getting that high interest rate out of the way. We've already talked today. We had a great conversation because now you realize that if you owe even 1 penny on that zero financing for 36 months, they're going to go back and get you interest for every single dollar they loaned you. And I explained some of this in my book here, the big book on retirement. I go in further detail in the second book I ever wrote. I've written 19 now, but the second book I wrote was the fine print fiasco, what they don't want you to know when you buy, borrow, and invest. And so if you call now, if you're watching this and you want to get a copy of both of these books, we'll send them to you at no cost or obligation. All you have to do is call the number you see on the screen. Or let's give the number out right now.
Yes, 919-794-7900. Or text Amanda to 600-700.
Now, let's talk taxes for a minute, because taxes right now are historically low. What should people be doing about their tax situation in retirement?
Just came out with a book this year. It's over 250 pages called Tax Savvy Retirement. And so who cares how much you have if it's going to get killed by the tax man? If you have a big piece of cheese, it turns into Swiss cheese really quick before you would see it. So we need to make sure there's ways that we can isolate some money from the tax man. There's some special tax balancing we could do. If you have a big gain and a loss, we'll sell the loss and sell the gain and come with that, take that money and now you have a tax-free, basically. So there are a lot of tax strategies out there that are overlooked, underutilized, and should be used all the time to put people in control of their retirement.
Let's dig a little deeper into that, because Roths play a big role in that.
Love the Roth.
And cash value life insurance can play a big role. So talk about some of the ways that you can get people tax-free income.
Yeah, well, the Roth is a good one, but the problem is the more money you make, the less you can qualify for it. So what I found, I call it Roth times 2, is the life insurance industry. Yeah. And matter of fact, if you haven't had your life insurance policy, if you have one, if you haven't had it analyzed in the last 5 years, you need to, because some of the life insurance companies, matter of fact, the biggest ones, the A-rated ones and above, have come up with something called a living benefit rider on your life insurance accounts. If you have a new policy, you may have that. If you don't, you really need to get it looked at, and you need one, because what this lets you do, Tom, lets you take your death benefit out while you're still here to pay for long-term care. So there's no need for a long-term care policy anymore if you have a life insurance policy. And the beautiful thing about a permanent life insurance policy is once you qualify, they can never kick you out. They can never raise your rates. You can even pay your policy off. So you could be sitting on an asset you don't even know. If you have a life insurance policy right now that doesn't have this, you're costing yourself a lot of money.
Yeah. I've moved more of my personal wealth to cash value life insurance. My premium was $226,000 a year on a 12-pay life policy, but all that money and more is sitting in there that I can take out tax-free. And what a lot of people don't realize is much of the money in annuities and life insurance is creditor protected, so they can't sue that. I'm from the state of Arizona. It's 100% creditor protected. That matters to business owners.
That's gigantic. That's huge. I mean, who wants to work all your life to build something only to be sued away with it? I mean, if people can attack you these days when they see that big, fat, juicy wallet you have, you're going to be a big target.
here we are again, chapter 5 of the big book on retirement. I'm Thomas Lipscomb here alongside the author himself, Coach Pete D'Arruda. Here we are, developing spending discipline. And I want, each of your chapters here, Coach, you start off with a quote. I wanted to bring this one up. It says, it's not your salary that makes you rich, it's your spending habits.
Yeah, and this is budgeting.
Yeah, it is.
And I don't like to call it a budget. I like to call it a spending plan. So let's write down, how do you figure out how much you're spending now? Well, you can look at your credit cards and your checkbook and see all the stuff added up. Or you can write everything down when you spend. That gets kind of tedious. Keep the receipts, scan them in your computer, that kind of thing. But then you come up with rough estimates about how much it's costing you to enjoy your lifestyle now. This is when you're working. And so that when you retire, we can have a judgment about what you're going to spend in retirement. So if you like to go out to eat on the weekends, you're probably going to start going out to eat more on weekdays when you're retired, because every day's a weekend. So we need to factor that in.
That's good.
And the whole reason why we save and put money, our money gets taken hostage by the 401k or 403bs or TSPs, because you give it, you can't get it back out. It's hostage. So we have a hostage situation. And we reach retirement, it's time to start rescuing those hostages. They start getting free. That's money coming back to you. And then you say, well, gosh, we should have put more hostages away, right? So the more money you can put away now, the more you're going to have later.
Yes.
But it's just the thing is, we figure out how much it really costs you to enjoy your lifestyle, not just get by.
Yeah.
Anyone can sit home and watch reruns all day long, but you got to have some excitement in your mind. I always encourage people to keep a brokerage account, maybe $50,000 to $100,000 in there that you're trading. And so you're doing research every day. You're looking forward to the earnings report. There's always something you're looking forward to.
I like
what
that.
I've seen in life, if you stop looking forward to stuff, you've got to quickly dwindle down to nothing. So we always have to have something we're looking forward to.
Absolutely. And, I love this chapter too, because speaking of developing spending discipline, it's not just the big main spending plan that you develop. It's funny because it reminds me of mitigating taxes in retirement and so many other things. You're building small things. Like your book, The Fine Print Fiasco, is what I'm thinking of right now, one of your early books. So this is one of your latest.
Second book I ever wrote.
Second book you ever wrote. But it discussed those core aspects of focus on little things here, and here, and they all build up into something rather, something you could be proud of.
Well, mountains didn't get built overnight. It takes, like when you build sandcastles, it took a bunch of buckets of sand to get a big castle. But I mean, without that first bucket, you didn't have a chance of the castle. And so the better the foundation, the more secure it was too. Take the same approach in the financial world. Firm foundation, lifetime income, put you in control, minimize or eliminate fees, commissions, expenses, and too much risk. And as we get into retirement, we want to be in control of our money, not our money controlling us. And we help people with that every single day. Approach retirement on your terms. We can help you. Thomas's numbers are on the screen there. You can see that. The book will help you get your arms around it, and we can help you put that plan together. No cost or obligation, by the way, if you're seeing this video. Just give us a call. We can meet with you and help you get started to that really good retirement you deserve.
There you go. Yeah, it makes a whole lot of sense, folks. Go ahead and call right now. Don't put yourself in the way of yourself having an absolutely amazing retirement. Whether it's just getting that second opinion, or you really don't know what's going on in your plans, you're just nervous about what's going on in the market either today, yesterday, or 5 years ago.
Well, there's no better time but the present to get it done, right? We can always put things off, but let's get ahead of the curve. Let's do the smart thing. If you do it once, you never have to do it again, too, by the way.
There you go.
Once you get that plan put together, it's autopilot, folks. Let's put you in that retirement autopilot.
I love it. Get that confidence, folks. Call Coach Pete and his fiduciary team. As he said, the number's there on the screen, and we will see you for Chapter 6.
Hey, I'm Coach Pete D'Arruda, president of Capital Financial. Folks, the financial world is very, very confusing. That's why we put together a series of educational videos called webinars. You can see them at any time by signing up at CoachPete.com. We'll see you there.
Everybody's putting their money in 401ks, but long term, that can be a problem.
Well, a lot of them are orphan 401ks. What that means is you work for a company. People don't work for a company 30 or 40 years these days. They work for a company for 4 or 5 days, sometimes, or 4 or 5 years, and then to go to a different company. So they leave their 401ks behind. So we call this splintering or orphaning. So what we've done is we open up a super IRA, and we roll all the different 401ks in there. Now you have them all in one place. And they're a lot better investment options when you have the own personal IRA than the 401ks. 401ks usually give you maybe 10 to 30 different options. Whereas your own super IRA, you can have 5,000 or more different options. So you have a lot more choices. You can even build guaranteed lifetime income into your IRA. That way you can't do that in 401ks.
Absolutely. And you know, another way to play the crypto is you don't have to actually do the coin thing. There's ETFs now where you get full exposure to it without all the hassle of.
That's the best way to do it for the average American who doesn't want to worry about it, because Fidelity has one, BlackRock has one, IBIT is a good one. There's some other good ones. There's even ones for Ripple and Ethereum if you don't want just Bitcoin. There's ones that have a collection, like a basket of them. So check with your financial advisor or do your own research. I think a lot of financial advisors may try to shoot you down again because they are maintaining the hold of your money in their managed accounts. And if you leave them with money, it's going to be less money they can manage, less money they can charge you on.
Well, and let's be clear where I stand on it. I'm not saying put all your money anywhere. I say 1 to 3%. Some people say 5. Some people say more. I'd say no more than 5 as somebody who's
just like physical silver and gold,
just a small amount, because the performance can be so high it can help the entire portfolio.
And again, and if you just put a little bit in there, if it does go away, you didn't lose the fortune.
Right. And now there's even a Bitcoin short. So if you don't believe in Bitcoin, you can buy something that if it goes to zero, you're like your million headed down to zero. So and just once Bitcoin went up, what is my risk? My risk is that it goes back down. And so I bought some of the short just to hedge against it going down. I hope it goes to zero, I hope the hedge goes to zero. But if Bitcoin goes to zero, I'll make.
So you're protected on both sides.
On both sides.
That's when once you start winning the game, you win the game, and you're winning Monopoly, right? You have Park Place and Boardwalk right now. You can build all the houses you want.
Right.
I'm back again with my friend Coach Pete. Coach, everybody I know has a side hustle. The biggest thing for me is, why are we not treating the side hustle like our retirement? We need to be throwing money into our retirement. We're working harder to try to make that extra income, and we're just spending all of it. We're not even putting it in our retirement. Why?
If you have a side hustle, like a second job, every single penny of that should go to a place that's going to benefit you and your family in the future. And the best way to do that is to put in what I call a time capsule account, which will grow and not shrink. So it'll grow it'll share with the market, but won't go down when the market goes down.
When the money comes in, you put the money in your retirement account, and then you pay everything else.
What's a retirement account? See, the confusion these days, and it's widely known that a real retirement account is going to give you lifetime income you can't outlive and can't go away. Mm-hmm. But yet Wall Street tells you they have a retirement account that'll give you this magic return. And you put the money in, and all of a sudden you start losing money. And you have fees. And all of a sudden the money's not there. So have a plan. And the plan needs to be a long-term plan, like your whole life. What do you want to do when you retire? Where do you want to go? How much is it going to cost? Let's put a plan together that will fund that for you so that when you get there, you don't have to ask permission. When we were little, we had to ask permission. When we're older, we shouldn't have to ask permission. But if you don't have money, you're going to have to ask permission.
It's going to be hard.
You have to ask the bank, can I please have some money so I can go on to a vacation? And the bank will say, when are you going to pay it back? So again, it's all about having the plan that's designed ahead of time to put you in charge and in control of your retirement.
Jackson just turned 3. Can you believe that?
Happy birthday.
3. And I feel like it flies by.
It does.
Every single year.
You talking to me?
Yeah, I'm talking to you. And you talked me into, setting up his account, and I did set up his 529.
Yep.
But I need to get back on track with some other things now that, hey, school's back in. Year-round's already back in. Regular calendar's about to go back in. So how do we get back on track? How do we set this up?
Yeah, it's about having a routine, and a positive routine, a routine that will get you in control. It takes about a month to form a good routine. It takes about 1 day to form a bad one. So the good routines are putting money aside for retirement, making sure your money's going to be there, make sure it's growing now, and make sure you can have a lifetime income from your money and know what that income's going to be ahead of time. Now, that sounds like a lot of steps, but we do that for every single one of our clients, and I've done it for the last 33 years.
What do I need to do to have that backup college plan for Jackson?
Yeah, well, my daughter, Carrie, I've had 2 529 plans for her over the years, so a North Carolina one and a Utah one, and she's using the Utah one. She's going to University of Alabama, and that's not a cheap place, so lucky for her daddy put some money aside. But there's more to life than the 529 plan. You could put money in your 401k plan and then borrow against it to fund your college education for your child if you wanted to.
Ooh.
I don't really recommend that. I think you're better off doing the 529 plan, having something that's segmented and that's destined to go to education instead of saying, I want to rob my retirement so my child can go to school.
Recently we went on our bucket list trip to Montana, and I met this couple, and they told me that they travel in the country, and they were well into their 70s. And I'm like, how in the world do they afford to do that? And I thought about it. They played their cards right. They retired because they invested and they did it the right way.
You know, investing is one thing, but what I've seen a lot of successful folks lately, they have a tax plan. So that's why I just wrote the book, The Tax Savvy Retirement. Doesn't matter how much money you have if Uncle Sam's stealing it all. So let's design your retirement money in a way that you will benefit more than Uncle Sam will.
You are right here in Apex, North Carolina.
Yep.
This is where you're located, and you can come visit. I mean, literally, he's a North Carolina man.
You know, Amanda, I've noticed an alarming trend lately where a lot of advisors from other states are trying to use AI and use a lot of advertising to get people to do a Zoom meeting with them, and all of a sudden you're sending them a check to a different state. I would never do that. So we're local. Come see us. Come. We have 27,000 square feet here in the Coach Pete land, we call it, in Apex. Come see us.
All right, Coach, what is the financial fill-up?
And there's the sounder. You remember when you're little, maybe you don't, some people do, being in the back seat. I remember being in the back seat of Mom's station wagon, and she'd go to get some gas. She'd pull in, and she'd hear. And then the guys would come running out. They'd check the oil, clean the windshield, and fill the car with gas.
Yay.
Oh, for 49 cents a gallon.
Oh, I love that.
That was back in Wisconsin in 1974, right before the embargo and all that stuff that happened. Anyway, it's all about making sure that we have enough income, and that's why we started talking about a financial fill-up, because it has to be something that we can understand. And when you get to retirement, you understand the fact that your bank account magically fills back up every year. That's a financial fill-up.
Coach, tell me about this race car team that we're building.
Yeah, well, you know, when you watch these races on TV, these are multi-million-dollar cars that are zooming around that track. Gigantic engines of the best of all technology. But what if you spent your whole life building a team, a race team, and when it came to race day, you forgot to order tires for the car?
Oh, no.
That's what's happening to most people these days with these gigantic 401k balances, or these retirement fund balances. They see a big lump sum, but they don't know what kind of lifetime income they can get from that. That's the tires on the car. And without the tires, the car ain't going where? It ain't going nowhere.
I thought I couldn't handle my own retirement.
Yep.
I'm just going to be honest because I'm a woman. But the truth is that anybody can call you and anybody can sit down and say, here are my finances. I need to set them up. Let's go.
I see a lot of people that just want to get their arms around what's going on.
Yeah.
And so a lot of times one of the two spouses handles that by default. Many times it's a guy. I don't know why, but that's what happens. And so I think both spouses need to know what's going on in their retirement accounts especially, but every account. And you need to learn. Don't just ask your spouse. Learn why your spouse is selecting what they're selecting, so that if your spouse isn't here, you can still go forward and not be intimidated. All right. So we spend a lot of time with folks like this, especially divorcees or whatever. So getting them right on the back on the track.
I need a concierge service. Do you handle that?
Oh yeah.
I got enough going on.
We have a private wealth division for $10 million and up too. But what I spend my time most of the time on our second floor, which is for anyone who wants to get started with a plan, has a plan they're not sure of, had a plan with an advisor they don't really trust anymore, or losing money, whatever.
Yeah.
Or getting close to retirement and realizing your planner never put together for you a retirement plan. If you look at all your statements and you don't see here's what your monthly income will be in retirement forever, in other words, can't go away, you don't have a true retirement plan. And most of you listening don't. If you have a 401k, you don't have a retirement plan. You have a building instrument that's building money up for retirement, but it's not a retirement plan.
So, Coach, most people are just saving money.
Yep.
Building up, like you said, that instrument. They got that 401k, they're building up, but they're not seeing a growth on their statement every month that their money's not making money.
Yeah. Well, if you don't really have a true retirement lifetime income plan, in other words, getting income for life when you retire, not dependent on the stock market, it's almost like building a gigantic skyscraper, but not having any furniture in it. You're building, but you don't really have that income. The income is the only thing that's going to get you through retirement. Social Security, that's income retirement, but you have to have some more. So your 401k, we need to translate what kind of lifetime income you can get from that lump sum and that big sky way around.
Yes.
But we serve around.
Yes.
But we serve our clients, and we make sure our clients are protected and taken care of and have no worries as they approach retirement and go into retirement. We call that the financial red zone. So if you're in that financial red zone, which is 5 years out of retirement, I like to say age 52. Because I'm 59 now, and about 52, I started worrying about retirement. So I'm using the Coach Pete meter right here. And the Coach Pete meter says at 52 and above, you really need your own total retirement plan, which looks at what you have now and translates that to lifetime income for you and your family. So if you don't have that, you need it, call right now. We'll put one together for you, a total retirement plan at no cost or obligation.
questions and answers. This is fun. It's been women and money. If I say it too fast, I think women in money. But we're going to talk about some financial challenges that each of us have had. I have Miss Jana, Miss Amanda, I'm Jackie, and Coach Pete. Yay, Coach Pete.
Hello.
It's going well, don't you think? What a fun series.
A guy can't complain when he's surrounded by 3 beautiful women. can he?
Aww. Flattery gets you everywhere.
Yes.
Yeah. Flattery gets you everywhere, and confidence in money gets you a long way. I think as I get older, I get a little bit more confident in it, and kind of wrapping up like what we've talked about. It's just the hard stuff is what I call it. These are the hard things that you have to face through the stages, and you just have to. You have to approach it. You have to hit it dead on, and handle it. And once you handle it, you check in with Coach Pete once a year to go over your plan. And then your plan is doing its job all by itself.
There's a phrase I use, and when you guys think about it, it'll make sense. Confidence with evidence.
Oh.
So my clients are confident because we have evidence.
Yeah.
The evidence is they have a total retirement plan. They've got their long-term care taken care of. They've got all their bills paid for. They've got their estate plan handled. That's confidence, and they have the evidence. So confidence with evidence. And once you get that into that level, you're fine. And you're bulletproof almost, emotionally at least. If we can make your money bulletproof, your emotions get bulletproof too.
Even better.
Sure.
Confidence with
cool.
evidence.
Dice takes care of Amanda's anxiety.
Yeah.
Yes. We can put we're going to work with you. We'll get you all set. We got that wedding to plan now. We're not going to get in the way. We'll let you spend what you need to spend. But
Yeah.
then after that, we got to roll our sleeves up.
Buckle down.
So you got to have some fun in life. If you never have fun, then what are you here? So you got to have some fun, have some goals, but just know I'm glad that you feel a little guilty about spending too much money on the wedding,
do.
because that's
I
a
feel
good
terrible
mentality.
about
If you don't care and you're just getting the credit cards out, you're gonna have to answer to them down the road. So
yeah, that's true.
But let's put a plan together. We'll be all right. You'll be okay.
Ladies, I was wondering if I could ask you both, do you feel some regret that you didn't know this stuff before you started working with Coach Pete a little bit?
I do. You know,
You're still young though.
I know, but where does
hard.
this leave me?
yeah. I think it's hard because I grew up with friends who their parents had it figured out. Like I learned about a Roth IRA from a girlfriend of mine's dad when I was 18 years old.
that's
I'm like,
great.
what is a Roth? And then I started doing research, and they were trying to tell me this. My parents didn't know anything about that. They were check to check, barely graduated, just working as hard as they could to keep a roof over our heads. So we didn't have those conversations at the dinner table when I was growing up. So I think the hard part was knowing like, oh gosh, at the time when I started my Roth, it was, I had to put $4,000 in a year and,
Fantastic.
and max it out. So it was like, that's a lot of money at that age. But, I just worked hard every month to divide it out and to max it out and said that was what I was going to do. But I think my regret is not sharing that information with other people coming up, because you just don't know what you don't know. And you don't also know if they're going to receive it from somebody your age. Like,
That's
are they
so
going to
true.
listen to you? I
We're
don't
putting
know.
together a course now. It's going to be a bunch of different pieces, but it's going to be grade school, middle school, high school,
love that.
college, and after college.
That's
Whether
great.
they're gonna be
Benefited from that.
What to do financially. Even grade school. I mean, if you're in grade school and you learned about a Roth or a dividend reinvestment program, they get you. When I had a paper out when I was 10, I wish somebody had told me about a Roth. I've been putting some money away
There you
instead
go.
of buying candy all the time.
Same.
But again, it's about knowing the right way to do things. And you're smart. You guys you're on the right track right now.
It's still tough though. I think it's you're still always questioning, am I doing the right thing?
Yeah.
And what do I need to be? I have a 13-year-old brother. My dad had a midlife crisis. That's another story for another
Wow.
time.
We went there.
But I try to explain to him, I'm like, write down on a sheet of paper everything that you're spending, or he said the other day, like, I don't like the way we're living. And I'm just like, oh, okay. I'm like, so I made him write down like everything my dad spends. And I'm like, if you don't like your life now, like this is what you'd have to make every year to even be able to afford this lifestyle, then you better be a doctor, lawyer, or surgeon or something to be able to afford this. And I think that kids these days don't know where the money comes from, how the money gets spent, and just what it takes to live. And I say, so to wrap it up, and what I was trying to say is the regret I have is not being harder on being more of a friend than a coach. To the younger people in my life.
Yeah, but we're going to make it easier with that series. We're going to come out with workbook series for
But I
different
feel
ages.
you on will they listen to you. I feel like even in broadcasting, in general, and being in radio and having blonde hair, they never listen to me. They think,
Absolutely.
Well, I get the feeling people don't
Can
listen to me
confirm.
sometimes too on air.
Yeah.
So our points are relevant and very important, and a lot of
Yeah.
people just ignore them, I guess, and think everything's going to be fine. Ignoring this problem is not going to make it go
No,
away,
right.
and financial problems get worse. Sort of like having cancer, it's going to get worse, not better, over your years.
Unless you take steps, yes.
big step and address it and accomplish it and conquer it, and then puts you in control.
You know, I was the complete opposite of Amanda, and I still kind of am. I don't want to be bothered with the details. I really don't.
Well,
Just handle it.
I have a lot of clients like that, Janet. They just want it done.
Yeah, I want it done. And I
Yep.
control so many different things in my life and my career. When it comes to this, I defer to the expert. I can't be an expert in everything, like you can't be in everything, but you are an expert in this.
I don't repair my own cars anymore.
Yeah,
No.
and I trust you. And so I think that was, I wish I had done my research earlier, and
Yeah.
it wasn't to educate myself on where to put my money and what to do. My education earlier would have been find a partner.
Yeah. Well, that's right. It's somebody you could trust, a teammate.
Somebody you
Yeah,
could trust
yeah.
where I knew
Yes.
let's check in once a year or twice a year
Yeah.
or whatever the thing is, because, you know, at different points in life, I wasn't working with that much.
Yeah.
You know, and I've been in sales forever, and I have huge years and I have okay years.
Right.
And I needed you many years ago to tell me on those huge years,
Where to put the money.
don't take quite so many trips.
Yeah.
And, you know, I had a lot of clothes.
But you have a lot of
Yeah.
good
Stupid
memories
stuff.
too.
I have
So
good
those are
memories.
priceless.
That's true.
Yeah.
So
Yeah.
really, I can't be mad at you for
I
spending
know,
money
and I
there.
don't regret it, but I
Yeah.
can't imagine. I didn't start a 401k until I met my husband. His dad is a accountant and whatever, he's doing our taxes. He goes, "Wait, can you give me your 401k information?" I was like, "I don't have one." He goes, "Well, doesn't your company match?" Or I was
No.
like, "You know what? I'm not super sure, but let me look into that." And so I was 31 until I started a 401k.
Yeah, but at least
okay.
you started.
All right.
See, the
That's
secret
okay.
is to start. I don't care what age you are. It's to start. Start a 401k, start your retirement plan,
Yeah.
start your long-term care plan, start something today. Don't wait till next year, because next year might not come, and if it does, it might not be the best circumstances. So let's get things done now while the water's calm,
Yes.
right?
Yeah.
Now,
Yeah.
you guys, I want to know from each one of you the financial challenges you've had or faced over the years and how you overcome it.
Oh,
How you
go ahead,
overcame it.
Janet.
So what about you? How did you overcome your financial? What were they and how did you overcome it?
You need a minute? I've got the worst one. Yours
ahead.
can't be worse than mine.
Go ahead.
It can. Go ahead.
I
Mine, I
racked
mean.
up a horrific amount of credit card debt. And I was in my 20s, and I, like, you know, we already said, I'm living the high life here. And I was wearing the clothes and the shoes, and it was a fraud because it was all mounted on a credit card. And I didn't pay the balance when it came. I didn't even I mean, I paid the minimum, and that accrued. I mean, it just racked up. And one day I remember opening the thing, and I would have anxiety. And I looked at that number, and it was a 5-figure, and it was a big number.
It's like getting a report
And I
card in the
remember
mail.
thinking,
Yes.
oh my God, this is half of my income. What am I going to do? And it's, you know, I'm getting a chill because American Express basically called me and was like, "Do you have any scissors?"
Yeah, cut the card.
Cut it up. But that was my biggest wobble and embarrassment. And I didn't tell anybody because I was so mortified that I had let it get out of control that I didn't want to call Jackie and say, "Hey, I know you're smart about this stuff." I didn't want to admit it to anybody. I wanted it to die and go away.
What
Wow.
lesson did you learn from that?
Holy cow, if I can't afford to pay this credit card off this month, don't buy it.
Yeah,
If I couldn't
that's
pay it in
great.
cash, I can't pay it on a credit card.
Great lesson to learn. And I don't think you should extend a car loan any longer than 4 years, by the way.
I
People are
agree
doing
with
5,
that.
6, 7,
Yeah.
8 years.
Oh,
That's
72
crazy.
months.
So really, if you can't afford to pay cash for it, you really can't afford the car. But
Yeah.
my max loan's always been 3 years. 3 years, because
Yeah.
that's bad enough, right? But
Yeah.
you see some of the folks, they're on their 4th car after they started buying overpriced cars, and they would drive for 2 years and then trade it in for another car.
Roll that
So now
negative
that
equity.
4th car has a value, let's say, of $60,000. Yet their loan they owe is $80,000 because
Oh,
it's
boy.
all
So
the
you're
other
paying
bills
all
on the
the
cars on there. So
depreciation.
be very careful about toys. Toys can get you in a lot of trouble, especially expensive man toys, we call them, like
I was
cars.
about to say, they think
but
toys
women
are for
fall
the
for that
boys,
too.
but
Yeah.
But clothes for women, makeup,
It's
clothes,
true.
bags.
Shoes.
Yeah.
You know, we all, I have a daughter. I know she's 20, so I know exactly what you guys are falling for. And don't feel bad because Madison Avenue spends millions of dollars a day to get you to do the bad things you're doing.
No.
I was
So the
influenced.
secret is, my mom taught me this a long time ago. When we go in the store, we didn't have much money. She said, "Keep in mind, little Peter," little Pete. She said, Petey, what she's called me, Petey, is you have the money, and the stores are trying to steal it from you. So she said
like
that.
that. She's smart.
And we
Money
go
in
in the
your
store,
pocket.
and I still remember that because your money goes. Well, you ever broke a $100 bill before? How fast does
gone.
it disappear?
Then it's gone.
So money goes a lot faster. How
Once
long
it's
did it take
broke.
to get that $100 bill? A lot
Yes.
longer than it took to lose it, right? You go to McDonald's a couple times, the $100 bill is gone these days. So be very careful about how you spend it. But Janet, you learned your lesson. And
was
so
a hard
then
one,
when
yeah.
you got, so you probably your credit had to recover a little bit after you
You
paid the
bet it
bill off.
did.
Your credit score went down, but now you build your credit back up. And
Yep.
when you charge something now, what do you do?
Pay it off,
Pay
as,
it
soon
off.
as soon as the bill
Pay
comes.
it off. See, I think it's
Get your points.
Wall Street Journal called me the credit card king in 2012. They wrote an article about me because I said I like to charge a lot, but I pay it off at the end of each month, and therefore your credit score gets higher and higher.
That's the tricky
and you get more
part.
rewards points. So
There
you can
you
be a
go.
credit card queen
Yeah.
by charging but paying off.
Yeah.
Charge it, pay it off. I remember the old Flintstones episode. Betty and Wilma got credit cards, and I remember them saying, "Charge it!" They run to the store, and then Fred and Barney kept getting the bills. So even back on the Flintstones, they were saying, "Don't charge on credit cards."
Oh, that's
All right.
great.
What about you, Jackie? What's the biggest financial challenge you've had? Or are we done with yours? Is there part two for you?
Yeah, I just feel nauseous, so let's move on. Let's
Is
move
there
on.
a part
from
two?
it. No, there's not.
So, but you overcame that.
I did, and it hurt so badly that I can feel it all
Hurt
over
so
again.
good, we say.
And I vowed never to go back. So
Somebody
I
sung
know
a
what you
song
mean.
about that. Hurt
Yeah.
so good. All right, so
Ah.
Jackie,
Okay.
what was the biggest problem you had or financial challenge you had, and how did you overcome it?
Mine is the saddest story here, probably. But a man of God told me once, "You're here on earth to learn lessons." So I've learned a lot of lessons.
At your own expense sometimes.
That's right. And I married a boy toy a little bit. He was 7.5 years younger, and he did not have very good responsibility around money. The one thing he did teach me, which was good, is that we bought a business.
Oh,
I
what kind
know.
of business did you have?
Bicycle shop.
Oh. Did you sell new ones or did you service old ones?
Oh, all new, you know, the people
They
who were
real fancy, those
retired.
fancy bikes?
bikes, yes, and it was a great
Spent
business.
a lot of money on a bike
Yeah.
these
and all
days.
that stuff. But he liked to trade some of the bicycles for other things, and there was a little bit of
Nose candy stuff?
I don't know if it was that or he just wanted to get a new car, and then the mechanic, right? And the
So he's doing a
mechanic,
barter
He's
system.
bartering.
Yeah, bartering.
it's called embezzlement, I believe.
Embezzle borrow.
Oh gosh.
Embezzle barter.
That's right. I just wish I would have known these things and had,
Right.
the separate and had a, you know what I mean? I
Yes.
wish I would have had a partner
how did
too.
you discover-
It's embarrassing to tell someone, parents-in-law, your own family,
Yeah.
whatever, that you've gone through this great misstep.
How did you
Right.
discover that he was doing this stuff?
I told you the saddest story on here today. Upon his death at 39 years old,
Oh gosh, that's
Gosh.
so young.
7 days away from being 40.
How did he pass away?
He took too many of those funny pills that the doctor gave you, the oxycodone. Remember during the oxy time when
Gosh.
Michael Jackson and the the
How'd you
oxy.
meet him?
I met him. He was a ski patrolman.
Were you out there skiing? Were you a ski bunny?
Can we make this a whole separate episode? I feel like this needs to
insane.
be.
I told you it was going to be the worst story.
Where were you? Were you skiing out in the mountains
in
somewhere?
Vail.
Oh, Vail.
Yeah, I worked for a broadcast network, and they allowed me to work in Vail. So
You know what just stuck out to me though is you used the same word I did, that you were so embarrassed. You didn't want anybody to know that you
It's-
had financial
and
issues.
we need to get past that because if other people hear the story, they won't do the same thing usually, right?
yeah, but that was a different era. You know what I'm
Yeah.
saying? This information just wasn't available to me. I wish I
Yeah.
would have. And some of the things that you talk about, this lifetime income and all that, those savings vehicles and distribution vehicles are new and have really neato tires and
they're
great
great.
bells on the bicycle and ding dong. It's just some bells and whistles that.
Financial products
Yeah.
get better every year, just like new cars do. Like the 2020 car is not as good as the 2025 cars are full of those bells and whistles these days, aren't they? So the financial products are better and better these days too. So if
Right.
you have an older product, 4 years or even 3 years or older, it's time for review because there might be some better ones out there. Plus, a lot of them I've seen lately have a lot of financial termites hidden in there. Those are unnecessary fees, risk, and commissions that are embedded into your plan that you can't see. We can see that. So we can do an analysis for you. All right, for you.
Okay. Oh, gosh, there's so many. I think my biggest regret is not having the confidence to ask for a raise, and because you're paying yourself. And I allowed people that have worked for 20 years. I've worked for so many companies, done so many things, sang at the bars in Nashville.
I love the Nashville bar scene.
Yeah,
It's fun. They like different bands everywhere. It's cool.
Real
Yeah.
estate, wholesale. I've worked everywhere. And I just never had, I always was so scared of the backlash or the getting fired. I can remember the anxiety of just like going in and just having the gumption to go in and say, you know what? That raise is going to pay for my retirement. That raise is going to pay for the things that I want to invest in. And I just always thought I couldn't do it. And I finally I just did it. I just started going and saying no. So I don't have that regret. Get what you're owed, y'all, so you can invest that money.
I would say to know your worth. How's
Yeah.
that?
Know your worth.
Yes.
Know your worth because you're worth a lot of money at the place you're at now.
Well, and everybody is. And I think that if you have experience, life experience is enough. You know, I hear some women say to me all the time, well, I've only been at this job 5 years. But I'm like, well, wait a minute. Overall, how long have you been in working
this field?
You're
right.
40 or you're 50. Get what you're worth. Don't let them hit you down on that. And then use that money to invest.
Save it. Yeah.
Yes.
Put a plan together, because then you can retire sooner too, if you want to.
Absolutely.
You can either retire sooner or keep working and build up even more money. So that's a good problem to have.
Yeah.
Should I retire
Yes.
now and have a great retirement, or should I work longer and even have an even better retirement? So that's a good decision, A or B, right?
Yeah, A or B.
That's a good A/B decision.
Well, and if they're not paying you enough now and you say, I got to keep the job, then keep burner A on. Start cooking on burner B, burner C and
like
D and
this.
E if you need to, and then figure it out. But don't, keep A going, simmering, but figure out what your options are. You always have options.
I like gas grills too, gas inside cooking. Now, each one of you's had a situation, and I know everybody watching probably has at least one. So come on in and let's discuss yours, and let's iron that out and get you on that right path.
Thanks for watching.
Yeah, we'll see you next time we do a series, folks. This has been a fun series. Thank you for coming.
Yes, thank you
Jenna,
so
thanks
much.
for coming.
It's been
And
so much
Jackie, as
fun.
always, thank you.
Thank you,
We'll
Coach.
see you sometime, folks. Give me a call. Let's get these books in your hand. Let's get that knowledge in your hand. And let's, more importantly, let's get your life in your hand.
How much of your Social Security income could potentially be taxed? If you know the answer to that, you could be the recipient of one of Coach Pete's free books. Isn't that right, Coach?
Yeah, we've got 2 books we're going to give away. You get your choice. You either get the big book on retirement, which is over 300 pages, one of the newest books I've written, and the absolute newest book I've written is Tax Savvy Retirement, over 200 pages to put you in control of the tax man before, during, and after retirement. Very good book as well. So you'll get your choice if you answer this question correctly.
All right, so this is the question. How much of your Social Security income can potentially be taxed? And here are your options. A, 25%, B, 50%, C, 85%, or D, the full 100%. Text or call your answers in to the numbers that you see on the screen and win your copy of one of Coach Pete's latest best-selling books. Welcome back into our series on the big book on retirement. I'm Thomas Lipscomb here alongside the author himself, Coach Pete D'Arruda. Thank you for joining us once again in our series, Know the Fundamentals.
Yeah.
It's huge, Coach. Know the fundamentals. Everybody seems to have their opinion on financial planning today. You can go to 17 different websites and they're going to have their little section on this or that with their opinion editorials. I don't know if half the time they're actually written by an advisor. But let's talk fundamentals.
Yeah, very important. I mean, if you watch any sporting event, you can tell the teams that the coaches spent a lot of time making sure that the players understood the simple tools and techniques, and then added to that.
That's good.
If you try to jump in like up here and you didn't learn down here, you're going to quickly fall back down. So building blocks, fundamentals, especially in retirement. What are some of the retirement fundamentals? Making sure you minimize your risk, minimize expenses, maximize what you're saving, maximize your income, have that autopilot where you never have to worry about outliving your money, and you've got at least that amount coming every single month for the rest of your life. It'll never be less, could be more. Knowing if you pass away, your spouse is going to be taken care of. Knowing when you and your spouse both pass away, your kids or grandkids are going to be taken care of. So there's a lot of different check boxes we go through. Nothing you really have to worry about. You can read about it in the book, or you can get your own plan done with us at no cost. But
Well, and that's kind of the whole point of all this, isn't it? You know, we talk about financial planning. You can get into the weeds and know all of these terms and what's going on here, there. But at the end of the day, most people just want to walk on the beach, want to swing the golf club, throw the rod out there and try to catch something good, go flounder gigging, you name it. Like most people don't really want to know this, but at a certain point, you got to find someone you connect, trust with, and make that one decision to get the plan. Because like you said in our last episode there, once it's done, it's done.
Yeah, we're more than happy to give you all this behind-the-scenes information, by the way. And you can put it in a file. You might look at it someday, you might not. But we have it all backed up. But we put all the important and pertinent information on a one-page plan for you, showing you in color, different colors, what it really means to you.
Yeah.
What's my lifetime income going to be based on what I have right now? What are my expenses going to be? And of course, the income better be higher than the expenses.
Exactly.
And so if not, we could tweak that. And so that's why it's important to be honest when we talk about what do you like to do in a day, a weekend day.
You like to play golf? All right, we need to put a price to that. Then we need to factor inflation in. What's that going to cost in 10 years? Oh, you like a cart? Well, a cart costs more money, right? So, you lose 10 balls every time you play. Well, we need to factor that in. So these are all things that we go through because you don't want to be surprised down the road.
Yes, that's right.
And so fundamentally, we go through everything and make sure that everything's in place.
There you go. That's what it's all about.
Yeah.
You got a great quote here from Jack Nicklaus talking golf. Learn the fundamentals of the game and stick to them. Band-Aid remedies never work.
No, duct tape.
Isn't that nice? Yeah, duct tape.
Yeah. No, I mean, but it's such a great solution that we have. There's no need to be cutting corners.
There you go. Yeah,
We
I
can
love that.
put you in control of retirement with the money you already have put aside, by the way.
Yeah.
You're not going to have to come up with money. It's already there. Let's just make sure it's in the right place.
There you go.
That's all we do.
Folks, the time to act is right now. Connect with Coach Pete's fiduciary team with the information that you see there on the screen. Get your questions answered, but even more important than that, let's get that plan. Take that worry, as you like to say so often on your radio show, Coach. Take that worry out of living in retirement.
Yeah.
And folks, we'll see you for Chapter 7 here shortly.
Hey, I'm Coach Pete DeRuda, president of Capital Financial. Folks, the financial world is very, very confusing. That's why we put together a series of educational videos called webinars. You can see them at any time by signing up at CoachPete.com. We'll see you there.
Welcome back into our series on the Big Book on Retirement. I'm Thomas Lipscomb here once again alongside best-selling author Coach Pete DeRuda, having a great conversation with you here as we're walking through this series. And Chapter 7 is all about understanding the end game. And I like this because, when it comes to retirement planning, something that you've talked to me about, Coach, is you want to understand an individual's dreams, aspirations, goals in retirement, and you can sort of work backwards from that based on what they have.
Yeah, and it's a fun process to find out what you really want to have happening in your life, and then we can work backwards, and we can, for most times, tell you that's possible if we do certain things now.
There you go.
We move this money there, and we put that money there, and everything's fine now. And so it's not about just hoping everything's going to be fine. We can give you a seal of approval telling you it's going to be fine. That's a big, big thing right there, because now you have a team behind you telling you everything's going to be fine.
Yes.
Instead of saying, well, maybe, perhaps, likely, could be. I don't like any of these kind of words. We want definite words with definite positive for you.
Exactly. And the end game doesn't just end or apply there. I hate to bring it up, but one of our colleagues here, Bruce, had a friend who poorly took out funds from a 401k and didn't invest them back in and was hit with that huge tax
You
penalty.
talked about that on the radio show a couple weeks ago. He asked me a question from a friend. And
Yeah.
you have 60 days once you take money out of your own IRA to put it in a different IRA, or you get that tax bill. That money becomes taxable. And so you got a 60-day clock. Or if you have it electronically done through a planning organization like us, it's done automatically. You don't have to worry about it. So
Easy
the burden of
breezy.
proof lies on the institutions, not on you when you have an institution help you like that.
That's
So
good. That's
again, that's a big time bomb for folks if they do the wrong thing with money, or your money in IRAs. When you take that money out, you're going to have to pay tax on it, unless it's a Roth IRA, which is tax-free. If you have a Roth and a regular IRA, then people say, well, which account should I start taking money out first when I'm in retirement? My opinion, if you got some money growing tax-free, keep it growing tax-free. Take the money out of the taxable accounts, keep that money growing tax-free over there, because the good thing about a Roth or life insurance, when you pass away, that money goes tax-free to your next of kin.
Yeah, so powerful. So powerful.
It moves on tax-free, doesn't disappear. That's good. And you don't even have to take it out if you don't want to.
No, it's true. Well, and we've just talked about a couple of situations here, but throughout this retirement transition, there are so many of these exit strategies that you need to have in place.
Yes.
Even into retirement, Coach, I think about laddering strategies, bucketing strategies.
Yep.
Technically, these have exit strategies at each point as well that are, you guys are always tailoring these, aren't you? Every now and then just updating, making sure everything's heading in the right direction.
32 years I've been doing this, Thomas. 32 years I've seen about any kind of situation you could ever imagine.
Yeah, I bet.
So that's why it's good to go, like when I go to my doctor, he's been around for a while, and so he's seen, no matter what I say, he's seen it before. He doesn't have to start Googling. You don't want your planner learning with you, in other words.
Oh, man.
And so we've seen the mistakes people have made, and our objective is to make sure you don't make those same mistakes.
There you go.
And the definition of insanity is doing the same thing over and over again, expecting different results. But a genius learns from other people's mistakes. Well, we'll learn from other people's mistakes to put a plan together for you that makes a lot of sense.
Very
That's what we do.
powerful.
Yeah.
Very powerful.
So get your own plan now. There's no cost or obligation. You got the book. The book is a great tutorial, by the way. But then you can have the teacher, the professor. You can meet with the professors and me, who I've educated all my advisors. They understand every tool and technique in this book.
Yes, absolutely,
So
without a
call.
doubt.
Let's get a plan put together and put you in control of retirement where you never have to worry about income again.
There you go. Now's the time, folks. Take action. Call the number you see on your screen. Text us, email us, whatever is easy for you. But the important thing at the end of the day, start the conversation.
Yeah, get started. Get started. Don't be afraid. It's nothing to be scared of, and we'll make it painless as possible.
As painless as possible. And
There'll be no finger pricks.
I'm turning the page, Coach. Coming up next, folks, we are discussing the next section, tactics. Stay tuned.
Hey guys, it's Parker Holland here with Capital Financial, Chief Wealth Strategist. We always like doing case studies on the radio, and now you guys get a visual representation on one. So we're going to use real cases, of course, no personal information, but these are scenarios we put together for clientele that we're looking for that safe, reliable, guaranteed income, but also the legacy. So we call this a spend and leave plan. It means you kind of set up a strategy, live off the icing, don't touch the cake, and we're going to give you multiple scenarios of how these actually work. So for the first case study we had come in was actually a radio listener a couple months back. They were currently age 54 and 55. They were targeting retiring at age 60 for them both. Now, of course, when there's an age discrepancy, there's layover months. That's not an issue for us. We're looking at the year in which they're both turning 60. So we had about roughly $2.5 million in retirement savings. This is a combination of IRAs, 401ks, Roths, after-tax funds. So this is just kind of giving you a big picture lump sum. So we're not going into a lot of the tax planning here. We're focusing solely on the income yield. Now, the benefit of this plan is there is not a risk tolerance we normally assess. Most people say that you have to put your age inside of a retirement calculator, and that's the difference between what's at risk and what's not. So that means that the safety and the risk should be about a 55-45 split. Well, in this scenario, we based on what makes the standard of living work, what makes the income work. And in this scenario, it was an even 1 million of the 2.5. What this did was we always work with A+ or higher companies, but they become the custodian. So instead of having a 401k like Fidelity or Vanguard, we use companies like Nationwide, Athene, North American, A+ rated insurers. So in this scenario, that million, based on this A+ rated company, got a 30% bonus, which pushed the insured value to 1.3 million. That's 300 grand going towards their retirement income, no matter what the market does. Now, when we run worst case scenarios, we're talking about 0% market return, absolute worst case. And then we run age of death, we just always look 30 years out. But the beauty of these plans is the strategies and such we target continue beyond. Now, I mentioned 30 years out, but we're talking about 30 years of income. So what we're targeting is once they're at that age 60 mark, the spreadsheet ran out at 34 years, but these are the numbers we're looking at. That means that the income received, worst case, no matter what the market did, would start at $90,000 a year. So they put in 1 million, they waited 5 years, the 1.3 guarantee would produce $90,000 a year at age 60. That means, yes, they would spend down the account by age 94, but they would still be getting this income as long as one of them's alive. So to kind of recap that, they'd get $90,000 a year, and even if they hit a $0 nest egg, they would still be getting that income. Now, we all know we'd have bigger issues if there was 0% returns for close to 40 years in this example. So let's run actual market performance. Well, the market ranges normally between 7 to 15%. Now, a lot of calculators are going to do a calculation saying, hey, it averages 10% a year. Well, that's kind of the middle ground. And it doesn't do 10% a year compounded annually. It does 10% annualized over a 30-year window. So we're going to have years of 0, and we're going to have years as high as almost 50%, but it normally ranges between 7 to 15. So same scenario, same age of death. The difference is the income would start at $100,000, but the kicker is over the course of their life through age 94, it goes as high as $250,000. So this income increases and compounds year over year. And all of this is under a spend and leave model. Live off the icing, not touch the cake. That means that that $1 million investment, not the total 2.5, just the $1 million based on market returns, would grow to over $4.5 million at death. That means they took out close to $4 million themselves and still had 4.5 left, assuming the market did what it's done over the last few investment cycles. So you guys want your own plan, you want your own strategy, give us a call, shoot us an email, go to our website, send us a text, and we'll run the numbers for you.
This big game, every move counts. Plan wisely to win the match. Sidestep the unexpected and charge towards your goal. Navigate through the challenges. Retirement is your end zone, and the touchdown is within reach. A successful retirement is your championship. Let Coach Pete design your customized income game plan today.
All right, we are going to kick this off strong. Inaugural episode of The Wide World of Investing. I'm Thomas Lipscomb alongside Bruce Rosenblum, leading the charge best-selling author, Coach Pete DeRuda. Now, Coach, how did you dream this show up, The Wide World of Investing?
Well, this is a wide world of investing, isn't it? You can invest in all sorts of things these days. When I was little, I had a coin collection. I still have it.
Yeah.
That's an investment. A lot of people invest in coins, Bruce.
Indeed.
You know, a lot of people invest in silver and gold.
We started tempting our children. My dad did actually with the 50 state coins, just to kind of start that process.
Collect them all,
Yeah, so it makes sense, doesn't it? All right, you invest. A lot of people I've talked to invest in wines. There's a big market. There's wine auctions at Sotheby's, the big old snobby auction firm, right? And then putting a value on things.
Yeah.
And here it is. When someone passed away, it's up to you. It happened to my wife. Her uncle passed away, and then we had to go clean his house out.